Very simply, I'm just looking for reversals to the upside to take trades, and then I take the trades based on fair value gaps that are inversed back to the upside. So these fair value gaps that you come down, form, and then break back to the upside after liquidity sweeps. Really easy way of trading, and honestly, it's been working really well for me recently. Usually what I'm looking for is this pattern, this candle pattern here, for example. These 3 candle pattern V shapes are really good. So you can see we've come down here, formed a fair value gap. Say this is your liquidity sweep. So we've come down, swept liquidity, formed a fair value gap. And then usually what you're looking for is these 3 candle pattern V shapes are the absolute best ones, although they are more rare. But if you get a pattern that looks like this with a major liquidity sweep, you're going to have a really high probability trade. And these are usually the ones that I look for the most. Although you can still have ones that do this, where they are 4 candle V shapes. These ones are almost as good and still have a really high probability of working. When you're trading from major liquidity positions, when you've swept them and then you get reversals back to the upside, you do have these really high probability scenarios where price action wants to come back and rebalance if inefficiencies above. If the theory about price action is that it's always chasing liquidity, once you've swept liquidity, if you can get an inversion back to the upside, usually it's going to go and find liquidity higher on the other side of the curve, and that's usually what I look for.